Have you ever wondered why Jim Simons, one of the smartest and most successful people in the financial world, decided to choose a path completely different from classical investment plans? Why did he decide to operate with purely mathematical logic, avoiding emotions, intuition, and market psychology? The answer is actually very simple, because he had learned a principle that 99% of people don't understand, but which can completely transform their lives: the true power of compound interest. Jim Simons, founder of Renaissance Technologies, renowned mathematician, and #1 in the hedge fund world, shows us not just a way to make money, but a completely new system of thinking. This system can be applied to every area of life, from finance to personal development, from relationships to skill acquisition. But first, let's admit one fact: we all misunderstand compound interest. There's a topic they always taught us in school's interest is a number added on top of something. When you add 10% to $100, it becomes $110. Then if you add another 10%, it becomes $120. This is simple addition, a linear growth model. But real compound interest doesn't work this way. Compound interest is not addition, it's multiplication. It's an exponential function, and this difference changes everything. Jim Simons applied this principle with mathematical precision in his business life, and the result: Renaissance Technologies showed an average annual return of 66% throughout its history, an unprecedented number in Wall Street history. This number cast a shadow over the results of Warren Buffett, George Soros, and all other famous investors. But Jim Simons didn't do this with emotions, market sentiment, or intuition. He used pure mathematics and algorithms. So why can't we understand this? The answer is actually very simple. The human brain evolved over millions of years, but during this evolution, it was trained to think linearly. For our ancestors living in nature, grasping exponential growth wasn't important. They needed to understand that traveling 2 days' distance in 2 days was a possible event, that 3 arrows were absolutely necessary to hunt 3 birds. Living with this linear logic wasn't a problem. But to be successful in our world today, exponential thinking is essential, and our brain is not biologically fully prepared for this. This is precisely why we cannot intuitively grasp compound interest. This is not our fault, it's simply a limitation imposed by evolution. Jim Simons was aware of this, and that's exactly why he set aside emotions and human intuition completely and relied on mathematical models. Now let's recall a famous experiment that demonstrates the power of exponential growth. Suppose you're offered 2 choices. Either you take $1 million today, or you start with 1 penny and continue for 30 days, taking double the previous day each day. Most people would choose $1 million because our brain considers it bigger and more real. But what does mathematics say? Starting with 1 penny and doubling every day, after 30 days you'll have $5,368,709. This is 5 times more than $1 million. But we can't see this because our brain sees nothing when evaluating what happens during the first 20 days. First day 1 cent, second day 2 cents, third day 4 cents. Even on the 20th day, there's only $5,000. People want to exit the system at this stage because they don't see results. But after the 21st day, the system explodes. On the 25th day, $167,000. On the 28th day, $1.3 million. On the 30th day, $5.3 million. Jim Simons knew this, and he never exited early. He trusted the system. Let's get more deeply acquainted with exact numbers. For example, you're comparing 2 different investor strategies. The first method brings an average return of 50% each year for 5 years, then 0 return, meaning nothing. The second method brings a stable 15% return each year for 30 years. Most people think the first method is better because 50% is much larger than 15%. But mathematics says something completely different. Capital that starts with 50% growth over 5 years increases approximately 6 times. If we take the first step with $10,000, after 5 years we'll have $60,000. Then it stays stable, and after 30 years it's still $60,000. However, capital that starts with 15% growth each year for 30 years increases 66 times. $10,000 turns into $660,000. The difference is 11 times. What's the difference? Consistency in time. In compound interest, the most powerful factor is time, not the rate of return. Jim Simons at Renaissance Technologies never set a goal to achieve maximum return in 1 year. His strategy was continuous, stable, and long-term growth. Each year interest accumulates on top of interest. Each increase builds on the previous increase. And as time passes, the system gains incredible power. Jim Simons' life story itself is the best proof of this principle. He earned a doctorate in mathematics at MIT, then taught at Harvard, worked on encryption in the defense sector, and finally established his own hedge fund. But he didn't become a billionaire immediately. In the early years, Renaissance Technologies showed average results. In the first 5 years, the fund wasn't significantly better than the market average, but Jim Simons believed in the system. He refined the mathematical models, completely eliminated emotional decisions, and let time do its work. After 10 years, the fund started showing extraordinary results. After After 20 years, Jim Simons became one of the world's wealthiest mathematicians. After 30 years, Renaissance Technologies entered the Guinness Book of Records as the most successful hedge fund in history. This is a living example of compound interest. The first year's nothing shows, the middle year's slow progress, but the final year's explosion. Now let's not reduce this principle only to the financial sphere, let's adapt it to other areas of life as well. For example, you decide to learn a new skill every day. The first day you learn very little information, the second day a little more. But during this time, each new day builds on your previous knowledge. After a month, you haven't just accumulated 30 days of information. You have a knowledge system formed by the compound growth of 30 days. After 6 months, after a year, this difference becomes even greater. For example, you decide to learn guitar. The first day you learn 3 chords. The second day you add 3 more chords, but you also discover new combinations with the previous 3 chords. The third day, along with new chords, you can already create a small melodic transition. After a month, you've already mastered hundreds of possible combinations. After 6 months, your hands start moving automatically and musical thought forms in your brain, and you can already play simple music. After 2 years, you start creating more difficult compositions. This is not linear addition, this is exponential growth. Each new skill builds on the previous ones, each new knowledge increases the power of the past. The same principle can be applied to relationships. The small attention, care, and respect you show someone every day accumulates. The first day nothing is different, the second day there's no visible change either. But as time passes, these small acts pile on top of each other, creating a strong, deep, and valuable connection. Suppose you show a small attention to your husband or wife every day, a smile, a thank you, a hug. The first week nothing changes. After a month, the relationship becomes a little warmer. After 6 months, the connection is deeper and more reliable. After 5 years, such a strong bond is formed that no crisis can shake it. This is exponential relationship growth. Jim Simons' philosophy is this: great successes arise not from big steps, but from small, consistent, and complexly accumulated steps. Now let's look at the exact methods Jim Simons applied at Renaissance Technologies. The most necessary rules of his system are these. First, eliminating your emotions. When humans make decisions with fear and greed, they think step by step. They sell when the market falls, buy when it rises. This is the opposite of compound interest. Jim Simons created algorithmic trading systems so that no human factor would affect the decision-making process. Computers traded based on mathematical models and were not affected by emotional fluctuations. Second, consistently accumulating small gains. Renaissance Technologies didn't try to achieve 100% gain overnight. On the contrary, it achieved 0.1% or 0.5% gain every day and continued to repeat this every day. Over a year, these small gains turned into large numbers through compound interest. Third, trust in the system and patience. Jim Simons knew that in the early years, results wouldn't be very impressive. He developed his system and started waiting. He waited 10 years, waited 20 years, and in the end, the result was historic. Here's a question that makes one think: if compound interest is this powerful, why isn't everyone very wealthy? The answer to this question is actually very simple, because many people cannot fulfill the requirements of this path. For compound interest to work, 3 rules are necessary. First, consistency. You must adhere to the system every day, every week, or every month. Taking one strong step and then stopping doesn't work. Second, patience. In the early years, results will be very slow and you'll feel like a failure. But it's precisely at this time that people start exiting the system. Third, reinvesting gains. Every time you start to achieve something, you shouldn't spend it. On the contrary, you should put it into the system so that it can bring gain in the future. Jim Simons never fully withdrew Renaissance Technologies' earnings. He kept them in the fund, and each gain became the basis for the next gain. This is precisely why the fund grew so rapidly over 30 years. Now let's apply this principle to personal finance. Suppose you're 20 years old and you save $100 every month. At first glance, this is a very small amount. In a year, $1,200. In 5 years, $6,000. But if you invest this money and achieve an average annual return of 10%, what happens? After 40 years, when you're 60 years old, you'll have saved a total of $48,000. But thanks to compound interest, you'll have $637,000 in hand. Actually, the amount you saved is $48,000, but the accumulation of interest on interest has created $589,000 in additional income. This is 12 times your direct contribution. Now suppose that because you started at 20, you have more time and you invest for 50 years. When you're 70 years old, you'll have $1,480,000 in hand, whereas you only saved $60,000. The difference is 24 times. This is the power of compound interest, and Jim Simons applied this principle not just in money, but in all of life. Let's also check the comparison with Warren Buffett. Warren Buffett is one of the world's wealthiest investors, and he always talks about long-term investment. But the difference between him and Jim Simons is that Buffett looks at fundamentals, company value, and long-term development. Jim Simons, on the other hand, focuses completely on mathematical models, statistical anomalies, and algorithmic trading. Both believe in the power of compound interest, but their methods are quite different. Buffett achieves long-term returns through emotional control and value investing. Simons completely removes emotions from the system and trusts only numbers. Interestingly, both reach the same conclusion: consistency, patience, and compound growth. Now let's transition to a different area. How does compound growth work for health and physical fitness? For example, you decide to start exercising today. The first day you run for 5 minutes and you get tired, and this is a normal event. The second day again 5 minutes. The third day you run for 6 minutes. After a week, you still don't achieve a very big result. After a month, you can already comfortably run for 15 minutes. After 3 months, your body becomes stronger and your breathing capacity has increased. Your energy level is now high. After 6 months, you're a person with the physical preparation to run a half marathon. This is not linear addition, this is rapid growth. Because every time you exercise, you create muscle memory. Each increase strengthens the body's oxygen absorption capacity. Each progress connects stronger neural connections in your brain. After a year has passed, you turn into a different person. After 2 years, you become so strong, healthy, and energetic that you're incomparable to the past. Jim Simons applied the same process at Renaissance Technologies. Small increases every day, small corrections in algorithms every week, small updates in the system every month. After 10 years, the system turned into a solution that was completely different from its initial state, powerful and effective. Now it's necessary to touch on a critical issue. What mistakes are made that prevent compound interest from working? The first mistake, lack of continuity. People invest for 1 month, then take a 4-month break, and then start again. This completely destroys compound interest. The second mistake, exiting early. When people don't achieve anything in the first 2 years, they move away from the system. Actually, at that stage, the main structure is being built. The third error, spending gains. Spending every time you earn something stops compound interest. Because in compound interest, gains must stay in the system and bring gain in the next period. The fourth mistake, expecting big steps. People want to achieve 100% gain in 1 year and become disappointed when they can't achieve this. Whereas 15% consistent gain per year increases capital 66 times over 30 years. Jim Simons made none of these mistakes, and that's precisely why he succeeded. So how does Jim Simons' philosophy differ from other famous investors? George Soros is based on market psychology and reflexivity theory. He analyzes people's behaviors and benefits from market emotions. Peter Lynch is based on fundamentals, the real value of the company, and sectoral research. Ray Dalio studies economic cycles and macro trends. Each is successful in their field. But Jim Simons, unlike them, doesn't take any human factor into account. He only looks at numbers, price movements, statistical correlations, mathematical patterns. For him, market emotions, company management, economic policy, or sectoral trends don't matter. Only mathematical probability and compound interest. This approach makes him unique, and that's precisely why Renaissance Technologies left all other funds behind. Now let's show this principle in a career path. For example, you're a programmer and you dedicate an hour of your time every day to learning something new. The first month, you'll see very little progress. The second month, you'll see a little more development. But after the 6th month, the technologies you've learned start to connect with each other. You apply this knowledge in new projects, solve more complex problems, and accelerate the next learning process even more. After 2 years, you're already a senior-level programmer. After 4 years, you're a technical leader. After 7 years, you reach a level where you can become the company's chief technology officer. This is compound growth. Each day's learning is built on previous days. Each project is more complex than the past ones, and each success opens a path to the next opportunities. Jim Simons showed the same method in his career. When he was a student at MIT, he studied mathematics every day. During his doctorate, he conducted research every day. At Harvard, he taught every day and continued learning. While working on encryption in the defense sector, he built new mathematical models every day. All these experiences accumulated on top of each other, finally laying the foundation for Renaissance Technologies. His career wasn't created overnight. It's the result of 40 years of compound growth. Finally, let's come to the deepest philosophical aspect of this principle. Life itself is compound growth. Everything you learn every day, every experience you live through, and every connection you build is the foundation of who you will be in the future. In the early years, this won't create big changes. But after 10 years, 20 years, or 30 years, when you look back, you see that who you are, what you've achieved, and where you are is completely the compound result of those small daily choices. Jim Simons' life is the brightest proof of this. He wasn't born into a wealthy family. He didn't inherit millions. He never won a winning lottery ticket. He simply loved mathematics and continued learning every day. He took small steps every day, and the system did its work. The result, a fortune of $25 billion and the title of founder of the world's most successful hedge fund. But for Jim Simons, this wasn't just about money. He applied the same principle to scientific research, philanthropy, and the education sector. The Simons Foundation became one of the biggest supporter funds in the field of mathematics and science education in the world and contributes to the development of future generations by allocating millions every year. This is also compound growth. What one generation learns is passed on to the next generation. Each generation builds on the previous one, and science develops exponentially. Now ask yourself this question: what system are you living in? Are you looking for instant gains, big steps, and dramatic changes, or are you creating higher growth with small, consistent, and logical movements? Jim Simons taught us that real wealth, real knowledge, and real relationships are never created by linear addition. They are formed by the power of compound interest, with time and consistency. If you understand this fundamental difference, you're no longer an investor who makes emotional decisions, is captive to market waves, and is tied to short-term gains. You become a strategist who thinks with a completely new operating system, acts with mathematical logic, and uses the power of time. This is the greatest lesson Jim Simons gave to the world. Success is the reward of being patient and systematic, not the result of instant decisions. He taught us that our brain hasn't evolved to grasp exponential growth, but we can overcome this limitation with mathematical logic. He taught us that the small steps we take every day are more powerful than big mountains in the long term. He made us understand that compound interest works not only in finance, but in every area of life. And most importantly, he taught us that it's possible to be free from emotions and trust the system. You can also apply this principle starting today. Start with small steps, be consistent, and be patient. Create conditions for time to work for you. In the first months and years, of course, you won't achieve results. After 10 years, 20 years, or 30 years, when you look back, you'll see a big difference. Jim Simons did this and made history. Why can't you do it? Just believe in yourself and continue.